We talked about the balance sheet, which is assets equals liabilities plus owner's equity. And also the balance sheet is like a snapshot in a moment of time to show exactly where your company is at that moment. Literally the next day it's going to change because you'll have different bills to pay, you'll have different things, different money you're getting. So it changes day to day as you go through, but in that moment in time, it's a snapshot. The income statement as we go through is more like a movie because it shows you the gradual changes in your how much money you're making or putting out, so your income or your net loss as you go through. This formula looks really complex, but at the end, what this really is about revenue, okay, and your expenses and what's left over. That's all it is. But it looks complex. You have revenue, cost of goods sold. Let's say, for instance, you're making giant 6-foot teddy bears and you're selling them for $60 a piece, and it costs you $17 to sit down there and make it. So the cost of goods sold is $17. The revenue, when you sell it for that amount of $60, by the time 60 minus 17 is $43. So you're gonna have a gross profit of $43, except by the time you're done, you sit down, you got to sit down there, you got to pay your taxes, you got to pay for the water, you got to pay for the electric and everything. So by the time you're done, you end up paying $13 for all those things. And we call those operating expenses. So now you have revenue, $60, minus the cost of goods sold, 17. And on top of that, you have to add in the other ones, they subtract that away from the $2 to $13. So 13 and 17 is 40. So $60 minus $40. Now you're making $20 on that bear as you go through. And then you have to take away taxes. So the government comes in, they want to charge 20% on the cost of the bear. So that's $12 on top of it. So 60 and 40 plus 12 is 50, $52. And by the time you're done, you have a net income on your bear of $8. You can barely stand it as you go through. I understand in the process. It looks easier this way as you go through. Revenue minus all your expenses equals your net income or loss. It's a pretty straightforward formula. You just got to keep in mind what you're subtracting out for your expenses as you go through. So cost of goods sold, how much they're sold for to you and or manufactured, and then the gross profit margin, and then you take out all the expenses, including a thing called depreciation, which is writing off a tangible asset as you go through. Everybody's got operating expenses as you go through. It just depends. Like Starbucks, they have a lot of operating expenses. You might say that Starbucks is always in hot water as you go through. So by the time you're all done, you end up with a net profit or loss as you go through. So revenue minus all your different kinds of expenses equals a net profit or net loss as you go through. Lonnie here, as you go through, he has a gas station and he provides customers healthy organic food. Shh, don't tell anybody. Lonnie's selling Cheez-Its and corn curls in there. Those are not organic food or they're not healthy, but he's making an awful lot of money as you go through the process. The last one you have to know about is statement of cash flows. If you're a big company, it's not as critical as a small company. You have to have money to pay your bills. You got to watch your cash burn, we call it, as you go through. So we use the cash flow, and it really is an activity to make certain that you have enough money to pay your bills coming up. If you don't, you may have a problem. So buying goods and credit can be a problem, just like a credit card can be as you go through. Cash flow management, it really is about the money coming into the business and going out. Be careful on the cash flow because of the fact that pay attention to how much money you have in the bank, because you need to be able to pay your bills, especially your employees, as you go through. So income statement is a movie. The statement of cash flows watches how much money you have and where it's going to. It's really critical to small businesses as you go through. And depreciation is a systematic write-off of a piece of equipment over time that you expend each year as it goes through the process. Take care.